Chris Jones here again with the next video in our 24 Rules for a Successful Business Exit series. Our mission here is to provide you with a set of rules that can help you achieve your business exit goals. These are rules that my team and I have gathered from assisting thousands of business owners with successful exits for over 20 years. According to a recent survey of 493 business brokers and M&A advisors, regarding deals that didn't make it past the finish line, poor financials and financing issues ranked as the top 2 obstacles completing Main Street business deals. Here are 4 major mistakes to avoid as you tighten up your financials. Mistake number 1, using financial statements that don't tell the story of your business. Over the last couple decades, I've had many business owners say to me, "Hey, I'm busy running my business, spending time on my financials doesn't make the company any money." Well, I could argue that point, but let me just say this. Your financial statements are the true diagnostic of your business, the ultimate report card. If your report card is hard to understand, buyers will not assume you scored an A in profitability. Most businesses don't need audited financials to sell, but they should follow generally accepted accounting principles as much as possible. And you should be able to explain to a buyer how a typical transaction flows through your financials. The second mistake is failing to show the true earning power of your business. And this is a common one. The typical business owner doesn't enjoy paying taxes, so they focus on tax-efficient strategies to minimize taxable income. This leads, unfortunately, to corporate tax returns that fail to illustrate the true earning power of a business. Tax returns and P&L should never, ever be shown to a potential buyer without first showing critical adjustments, such as adding back depreciation and amortization, interest expense, your current salary, benefits, and non-operating expenses like the owner's personal vehicle payments, sports tickets, travel expenses, etc. Another key adjustment in this area is normalizing expenses. For example, do you own the real estate and rent it to your business? Are you charging a fair market rate, or does it need to be adjusted? It's impossible to properly value a business without understanding its true earning power. This brings us to mistake number 3, failing to include your bookkeeper and accountant. The right bookkeeper will be able to maintain your books and should provide regular monthly reporting. Accountants are not only critical for your annual tax planning, they'll assist you with advanced exit topics such as restating your balance sheet prior to sale, by removing assets that aren't essential to the business operation and aren't being sold, switching from cash to accrual basis accounting, and tracking your discretionary expenses, those things we talked about previously, adding back. We like to work closely with the company's accountant to make sure no add backs are missed. And your accountant can make your life a lot easier during due diligence as well. Finally, mistake number 4. This mistake has killed many deals, and here it is. Ignoring the balance sheet and ignoring net working capital. This is such an overlooked point that I'll be doing another deep dive video on this topic alone. But today, what I'd like you to do is get your balance sheet out right now and take some notes. The balance sheet is where you determine what is included and excluded from the sale. Most private company sales are sold on a cash-free, debt-free basis. So take your balance sheet, write the word seller next to your cash accounts, your checking and savings. Do the same for debt, such as bank loans, leases, lines of credit. As a seller, you keep the cash and you pay off the debt with the proceeds of the sale, much like paying off the mortgage when you sell real estate. These type of nuances exist throughout the entire balance sheet, every line. So you want to walk through a similar review process with your current assets, fixed assets, current liabilities, accounts payable, long-term liabilities, every line of the balance sheet. Those are the 4 major mistakes to avoid. If you tighten up your financials and avoid these mistakes, it will pay huge dividends when you sell. If you want to learn more about this topic or how to value your company, you can check out more of our videos here or give us a call anytime. See you in the next video.